It's a really strange moment. You look at the headlines and they're just full of volatility, uncertainty, but then you look at the markets and they're buzzing right near record highs. So, what is going on? Well, today we're going to pull back the curtain on that very question. Let's dive in. All right, here's how we're going to break this down. First up, we'll tackle that big question everyone's asking. Then, we'll zoom out and decode what's happening with global earnings. After that, we're going to focus on a really standout story, India's growth engine. And finally, we'll tie it all together and figure out what it all means. Okay, let's jump right into part one, the big market question. Why on earth are markets near record highs? I mean, it's a totally fair question, right? You see all this chatter about stubborn inflation, geopolitical drama, big economic shifts, and yet the major indexes are just hanging out near their all-time highs. So what's the secret sauce here? What's the hidden force propping everything up? Well, believe it or not, the answer really boils down to one single powerful factor, and that is strong corporate earnings expectations. Yep, it's all about the belief that companies are just going to make a lot of money. That's the bedrock, the foundation for all this optimism we're seeing. But to really get a handle on this, we can't just look in one place. We need to zoom out and see what the whole world is thinking. So let's decode those global earnings. Just look at this number for a second. Around 15%. That's the projected jump in earnings per share for the S&P 500 in 2026. I mean, that is a massive vote of confidence in where things are headed. We're talking serious growth. So what's fueling this incredible optimism? Well, it's kind of like a perfect storm of good news. You've got this AI supercycle kicking in, a huge wave of AI investment that's boosting everyone's game. Then there's the chance of interest rate cuts, which, makes it cheaper for businesses to borrow and grow. On top of that, you've got some targeted government spending and just this relentless, strong demand for cloud services. It all adds up. Okay, but let's be real, it's not all smooth sailing. There are definitely some storm clouds on the horizon we need to watch. Inflation in the US could be stickier than anyone wants. The slowdown in Chinese economy could create ripples everywhere. Geopolitical stuff is always a wild card. And honestly, there's still a big question mark over whether all this crazy spending on AI is actually going to pay off. But here's what's really interesting. The expectation is that this growth is going to broaden out. It's not just going to be about the Magnificent Seven tech giants carrying everything on their shoulders. The thinking is that this rally could become much wider and, because of that, a lot more sustainable. All right, now I want to pivot and zoom in on a market that is writing a completely different but equally powerful story. Let's talk about India's growth engine. Now, to really get what's happening in India, you need to understand this key idea, an earnings-led growth cycle. What does that mean? It means the stock market isn't just going up because of hyper sentiment. It's going up because companies are actually making more money. Their profits are rising. It's growth based on solid fundamentals, which is a really healthy sign. And get this, after a little while in the single digits, corporate profit growth in India is expected to really kick into high gear, accelerating into the mid-double digits. That is a seriously powerful trend. And that strength is showing up in some pretty eye-popping market forecasts. I mean, look at this range. Some brokerages are calling for the Nifty 50 index to hit somewhere between 28,100 and 30,000 by the end of 2026. Wow. So what's the engine behind all this momentum? Well, it's a four-cylinder engine, really. First, you have super strong domestic demand from a rising middle class. Second, there's a huge push in infrastructure spending, both public and private. Third, you've got helpful government policies like GST and tax relief making things easier. And finally, the companies themselves are just financially healthy. Their balance sheets are strong and they're ready to expand. And if we look a little closer, we can see exactly which sectors are leading the charge. You've got diversified financials, which are thriving with all the credit growth. Automobiles are flying thanks to all those domestic consumers. Capital goods are in a sweet spot because of that infrastructure boom. And even telecom is having a great run. But just like we saw with the global picture, it's not without its risks. For India, a few things to keep an eye on are a domestic recovery that might be slower than people hope, headwinds from the global economy that could hurt exports, and, of course, the fact that some parts of the market, especially small caps, are looking pretty expensive. Okay, so we've looked at the world and we've drilled down into India. Now, let's put it all together. What does this all mean? This comparison really sums it up perfectly. You've got the global outlook, which is being driven by that AI supercycle and hopes for easier money. Its strength is in tech. Then you have the Indian outlook, which is all about domestic demand and policy reforms, with its strength in areas like financials and autos. Two very different stories, but both pointing towards growth. And really, when you boil it all down, this is the key takeaway. Strong earnings expectations, not just globally, but in India too, are the main pillar holding up the markets right now. So the crucial point, the thing you really need to remember from all this, is that corporate health is going to be the decisive factor. The actual profits and performance of companies will shape where the market goes from here. Which leaves us with the ultimate cliffhanger, doesn't it? As earnings season unfolds, will the reality actually match these incredibly high expectations? That's the billion-dollar question. Thanks for tuning in.
Hit the subscribe button to get up to date.